Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Ty. How are you?
Good morning, Dean. I'm doing great. How about yourself?
Good. Thank you. Today we're going to talk about investing moves you should never make in a down market. And unfortunately, we've had a lot of that lately. There are some moves that you should make in a down market, some moves you definitely should not make. And today we're going to talk about those moves you should not make. And the first thing we're going to talk about is pulling all of your money out of the stock market. This is something that Tyler and I have seen people do in the past. In 2008, we saw a lot of people do that. In hindsight, you look back and see what would have happened had they kept the money in the market and not make a second mistake, which was if they did keep the money in the market, they became very conservative at the bottom. Those are two things that are very detrimental to a portfolio. But right now, we had heard some people pull their money out of the market completely, especially after March 23rd when the market went down. I believe on that particular day, the Dow was down about 35%. And what happens when you pull all your money out of the market, and you probably have heard this before, is you lock in your losses. So you have really cut your opportunity for recovery. There's an old saying in the financial world that the stocks or the investments that brought you to the bottom are probably best suited to bring it back up. So Tyler, as far as pulling all the money out of the stock market, what are some of the other things that we talk about when people think that they should do that?
Yeah, Dean. So when it comes to investing moves that you should never make in a down market, as you had mentioned, pulling all your money out of the market is probably number one, and that's one right now that is relevant. More so a couple months ago, like you said, Dean, when the market hit the bottom, that came on March 23rd, and that was where the market, from the beginning of the year through March 23rd, the Dow was down about 35%. However, from the high point that it hit in mid-February, it lost about 40% in a month. So in 1 month, when the market's going down 40%, oftentimes human emotion gets the best of a lot of us, and you think, man, I just want to go and take everything out of the market. I want to try and cut my losses, but at the same time, you're actually locking in your losses if you sell when the market is down 40%. So when it comes down to pulling all your money out of the stock market during a market downturn, actually looking at it the other way, where a market downturn can be a long-term investor's best friend. And what we mean by that is, even though over the short term it makes you a little bit queasy and you don't like when the market takes a big dip downward, it actually means that you can invest more at a fraction of the price. So when the market is down, stocks, they're essentially on sale or on clearance, so you can get more for your money. So for example, Apple, it could have been trading at $300 a share before the big market downturn, and then if it lost a good portion of its value, maybe it's $250 per share now. So you can load up on more shares when the market is lower, and when you're buying low, that gives you much more opportunity to recover that much quicker. So by loading up on stocks when they're on sale or when they're lower, then you'll be setting yourself up to see potentially bigger gains once the market does bounce back. So really, when it comes to pulling all your money out of the market, that's something that you should never do during the middle of a market downturn, but instead use it to your advantage and try and actually buy low, because that will allow you to recover quicker, which leads me into the next thing here is we always recommend that people hold cash within their portfolios, because if we don't have any cash, then we can never buy low and sell high, because there's no cash there available if we don't have any. So That's why you always want to have cash available within your portfolio, which will give you the flexibility to go and buy low during a market downturn. And then over time, as the market continues to trend upward, you might want to pair some of your gains and use that to build up cash over time, to that way always give you that opportunity to buy in low.
Okay, and there's a couple other things here too. When you're looking at the market being down like that, remember, right now we are in a scenario where interest rates are at an all-time low. So people who are sitting on cash, first of all, we do like the idea that you have cash positions, whether it be in savings or whether it be in your current investment portfolio, as Tyler said, so you can use it to buy when the market is down. But if you're in cash positions now at the bank, make sure you have enough money set aside, especially during a recession or a down market, to take care of emergencies. You want to rely on paying cash for things instead of having to put it on a credit card, not knowing if you're going to have a job next week or not, and then having credit card debt. So we want to see cash reserves built up. But at the same time, if cash reserves get too heavy and you're making nothing on it, your money's not working for you. Remember, we're in a once-in-a-decade opportunity here with the market being down that does give you the ability to buy some significant stocks or investments at a low, or at least significantly lower than they have been in years. So it's a good opportunity. And for those retirees who I hear this a lot, both of us do, and that is, well, I'm in retirement, I have to get more conservative. Do understand that conservative and safe are not the same. I bring this up quite often. Safe and conservative, definitely not the same. However, conservative is going to be safer than a moderate or risky position. We do understand that. But at the same time, if your money is not working for you, when the market is down, you're going to buy better value because you're getting significantly more shares than when the market is up. So put some of that money to work for you. Don't expect, a significant increase right away. Remember, investing is still based on time, okay? And when you're in retirement, everything doesn't stop. I hear a lot of people say, well, I have to get conservative right now because I'm in retirement. Well, we hope you live another 20 or 30 years past your retirement date, so therefore you still have to be a long-term investor, but you have to be short-term aware. You need to make short-term moves. You need to rebalance. You need to pull some of those investments that drifted too far away from your original plan. You need to look at sectors that are performing well and others that aren't. The international market is sort of funky right now. There are certain positions in the international market that are doing well. There are other places that aren't doing well based on the virus. So all international positions aren't going to be a good place to go, but there are some right now that are performing well. So pulling all your money out of the market when the market is down or during a recession is probably the number one thing that we recommend you do not do.
Yep, and Dean, the one last thing that I wanted to point out when it comes to not pulling all your money out of the stock market, it's important to get with a good financial advisor, a good financial planner that can help you with your portfolio, because you won't be as tempted to want to do that in the first place if your risk tolerance is up to par. Meaning that, if you're retired and you probably don't want to have everything all in stocks, you want to have a mix of some bonds and some cash to cushion the blow. So that way, if the overall stock market is trending downward, then you're not taking the brunt of that, and you've got some bonds and cash to cushion that. You may be down a little bit, but if the market is down, when the market was down 35%, maybe you were down only 10% if you were allocated according to your risk tolerance and had a good chunk in bonds and cash. So that's the one last thing that I wanted to point out, where you probably won't be as tempted to pull all your money out of the market in the first place if you have some different conservative positions within your account.
Okay, the second thing we're going to talk about when it comes to investing moves you should never make during a down market is trying to time the market. There are some significant studies out there. You can go on the internet, Google it, and find out, best days and worst days in the market since 1934, since the Great Depression. And you're going to find out for those people who significantly try to time the market, they typically lose out on that situation. We're big advocates of just dollar cost averaging. Now, remember, we do believe that you should be buying more when the market is down provided they're good investments. That is not timing the market. That, we're buying the dip. We're just being shrewd with money decisions. But trying to time the market, we have one client that I think, there was one time here during March of 2020 when the market was down pretty significantly. About every third day, we would get an email wanting to know if we were buying certain positions because the market was down 2% based on the previous day. And that is definitely something we don't want to do. And part of the reason is we really do not look at days and weeks when it comes to your investment. We look at quarters and years. And that's how you should look at it too. If you're monitoring your investment portfolio on an hourly basis or every day, chances are your mentality is a little bit more as a trader, which probably isn't a good thing if you're doing some retirement planning. As an investor, you need to look at quarters and years, not days and weeks.
Yeah, Dean, really good point there. Trying to time the market definitely isn't something that works in everyone's favor. And what it means is trying to sell your investments when the market reaches its peak just before a downturn. So if we go back and look at the current stock market volatility that we're in, that would mean trying to time the market and sell at the end of February of this year, just before the market downturn into March. And in theory, it sounds like a smart move. That's what everyone wants to do. You want to try and sell high and then buy low. But in actual practice, it's pretty much impossible to try and achieve that just because the stock market is so unpredictable, and oftentimes many experts have trouble even trying to explain why it does what it does. So that right there just goes to show that people who are continually studying the market every single day of their lives, if they can't even explain why it does what it does, then the everyday person trying to time the market usually isn't going to work too well. So what happens then is, if you sell your investments at the wrong time and try and time the market, it could cost you big time, because if you were to have try and pulled your money out of the market a month or two ago, you would have missed out on a ton of growth. But if you wait too long to sell and the market crashes, then you miss your opportunity to lock in some gains. So what we recommend is, now first off, we recommend being allocated based on your risk tolerance to begin with. But then in addition to that, we recommend rebalancing and tweaking things over time, but most importantly, being invested for the long term. And Dean, as you said, where we look at things more so quarterly, semi-annually, and annually, as opposed to every single month, every single week, every single day. We joke around with people that you'll get an ulcer if you do that, trying to look at the market every single day and trying to time the market each and every day. But instead, we want to be, now we're near-term aware, but we want to be long-term focused. We want to look at what the market does over the long term and make sure that we have positions that are going to, that we're going to succeed over the long term, but yet we will make little tweaks in the short term where if we have a stock or a different mutual fund or ETF that's doing really well in the short term, we might give it a haircut, as we call it, where we actually sell it off, take some profits, build up cash. So that way, if there is a crash, we have some cash that we took at a high point. And then if the market does dip, we might take some of our cash and slowly start to buy in low that way. But we're never making huge moves across the board where we completely buy in and then with everything and then sell off and go 100% cash, because that is pure trying to time the market. And again, timing the market doesn't work for the experts, and it's probably not going to work for the everyday person either. So again, the second mistake, or the second investing move that you should never make in a down market, is trying to time the market.
Okay, before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Packerland Drive in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, the next thing we're going to talk about, investing moves you should never make in a down market, is betting all your cash on a few individual stocks. It's easy for people to get into that situation. However, it's very dangerous. Diversification is key. You hear people talk about that a lot. You want to diversify. Diversify is nothing more than taking a larger number of investments. So you take the risk and minimize it because you have more investments working for you. You have some hedging against the others. Some go up, some go down. It's not as exciting, especially when the market is screaming up on a handful of individual investments. You wish you were all there. But if you have the stomach and the tolerance to take the losses from those fewer investments when the market goes down, that's typically what happens. The fewer investments you carry in your portfolio, the less you're going to be diversified. And again, diversification, just so you know, does not take away market risk. Market risk will still take down a diversified portfolio, but it should take it down less than a portfolio that isn't diversified or only holds a few investments or holdings. So, for instance, during this time period, we've had a lot of people wanting to put all their money into Zoom and Costco and Amazon and Apple, or they will take an approach and say, okay, there are stocks that are down 50 to 75%. They've got to be a great value. Well, not necessarily. Many times there are stocks that are down 50 to 75% that was triggered based on, the coronavirus pandemic or something like that. But because they were weak going into this situation, they typically are going to be weak coming out of it. And we heard of one investor who unfortunately sold out, like we talked about earlier, when the market was down. So he really did lock in his losses. And then when he decided to get back into the market, it was some months later, he missed most of the gains. And then he wanted to try to catch lightning in a bottle. He wanted to try to catch up real quick. So what did he want to do? He wanted to invest in oil and gas stocks, cruise line, and airlines. I mean, if you can look at one individual who made all the mistakes possible based on the market, going down, he was one of them. So, the last thing we want to do is take away your diversification and go into a few individual stocks.
Yeah, Dean, really good point there. But yeah, betting all your cash on only a few individual stocks right now is another one of the worst things that you can do. And there's people right now that they're wanting to go and buy oil, cruise lines, airlines, and retail or leisure stocks, which are all the sectors that are currently very banged up due to the whole coronavirus and the shutdown that's accompanying it. And it represents an example of something that you don't want to do. So just like you mentioned, Dean, another example that I have is people, they'll buy oil, or they want to buy oil at the very bottom, and it's okay to buy, to have that be a portion of your portfolio, but there's people that want to put every single penny of their retirement fund in oil stocks. And there was someone who wanted to buy, on their own, they went and bought an oil stock, and it went up 15% in one day. But then the next day it went down 20%. So it just goes to show that if you're going to invest in single stocks that are in extremely volatile industries right now, you have to monitor it, and it almost forces you to try and time the market, which is the last thing that we just talked about. That's the other big thing you shouldn't be doing right now. So now you're doing two bad things by banking all your cash on only one or two individual stocks, and then trying to time the market with those individual stocks. So that's two negatives and one there. If you try and invest in things that are extremely beat up because they're so volatile, then you have to go and you have to monitor it daily. And when it goes up, you're trying to sell it and catch lightning in a bottle. And almost every time that never works. In addition to that, betting your cash on only a few individual stocks is something that you don't want to do, because you go back and look at a company like Enron, for example. There's so many different times or stories that you hear about people who actually worked for the company. They had all their retirement fund in that stock, and it went completely bankrupt. And because they weren't diversified, they felt the brunt of it, and they had no retirement fund after that. In addition to that, a company like GE they're not bankrupt or anything like that, but they've really fallen off. And 20 years ago, they were voted as the #1 overall Fortune 500 company in America, and here 20 years later, they're an afterthought. So it just goes to show that you can't bank your whole retirement account on one company and try and buy them low in a market downturn. And then more recently, something like Luckin Coffee, where that's another stock. It's a Chinese-based company, and they actually had some problems with their books where they were not being truthful with their numbers, and that stock is now no longer listed on the exchanges here in the United States. So that's something where there's so much risk when it comes to single stocks that what you want to do is, and we're not saying don't invest in single stocks because we like those for certain clients, but what you should do is you want to be diversified instead of only banking everything on 1, 2, or 3. Try and go for 5, 10, 15, or 20. You want to try and get a little bit more diversified. And then even if you want to get even more diversified, that's where ETFs or mutual funds come into play, which are like a basket of single stocks all into one that contains anywhere from 50 to 500 single stocks. And that really allows for diversification. And with a mutual fund, there's a mutual fund manager that is constantly buying and selling those for you. So you don't even have to worry about what single stocks are in there. There's a mutual fund manager doing that, and they diversify your portfolio for you. So again, the third investing move you should never make in a down market is betting all your cash on only a couple individual stocks. You want to stay diversified. Okay,
good points, Tyler. The next one we're going to talk about when it comes to investing moves you should never make in a down market is taking on debt. Especially if you really don't know if your job is going to be secure. The last thing you want to do is take on debt. And the debt that we dislike the most is taking on an additional mortgage. So if you're buying up during this particular time, not necessarily a good thing to do. However, mortgage is an appreciable asset. In other words, you are investing in yourself, provided you can sell your home for more than what you bought it for. So it does appreciate. It's just that carrying a 30-year loan at this time of your life or when the market is this unstable is not really in your best interest most of the time. The other debt that we don't like, and I think it's usually not as large as a mortgage, but it's more crucial because of the interest rates, and it is not an appreciable asset. It's a depreciable asset, and that is credit card debt. So taking on significant debt during these times is something that we don't recommend. As a matter of fact, it's just the opposite. When we go into a recession or a down market, we ask people to go back and look at possibly cutting debt, cutting expenses. Go back and see what you can get rid of instead of what you should be adding to. So look at it. We're in an economy right now that was booming before the pandemic. However, the pandemic brought things to a screeching halt in a lot of sectors. Going back to work has helped, but now they're starting to see, some of the increase in the virus. So some of these workplaces are being shut back again, shut down. Some states are doing the same thing. The last thing you need to do is take on debt.
Yeah, Dean, really good point there. The only other thing that I'd add when it comes to a move that you don't want to make during a down market, taking on debt, if you don't have debt or if you pay off your debt, what that does is that actually allows you to, and it frees up more money for you, so it allows you to invest at a low with no debt. Because if you don't have debt payments, if you don't have a car payment, credit card, student loans, you can take the money that you would otherwise be paying off debt and you can use that to invest at a low. Take that and open an account and invest when the stock market is at a low point. So that way you want to pay off debt as fast as you can. So that way during the next market downturn, instead of that money that would be going toward debt, you can now use it to invest it, buy in at a low point, help it recover that much more, and grow your money over the long term, as opposed to send your money to different, send your money to pay off debt. You want to take that money and then invest it. So again, the last thing you want to do is take on debt, and by not having debt, it actually allows you to buy in at a low, and it frees up more cash for you right now during a market downturn.
Okay. The last thing we're going to talk about is, the last thing about investing moves you shouldn't make during a market downturn is borrowing money to invest at a low. And that also includes, buying investments on margin. So let's talk first about borrowing money to invest at a low. When the market was booming in 2006, 2007, before the last Great Recession, we heard of a number of people taking money out of their home, taking the equity out of their home and investing it. And unfortunately, many of those people were still paying that mortgage when we talked to them as recently as this year, 2020. Horrible thing to do. Do not let somebody tell you that borrowing money to invest because the market is down is a good thing to do. If you cannot afford to possibly lose that money in the market, you should not be taking and borrowing money to put it in the market. That doesn't necessarily include your 401ks because that's money that you've accumulated through your employer as you go along. But if you have $30,000 of equity that you could take out of your home to invest, absolutely the wrong thing to do. And also understand that buying on margin is borrowed money, and you have to pay that back. So there are, investing platforms, everything from, Fidelity and Schwab and Vanguard and TD Ameritrade, T. Rowe Price, they all allow buying on margin because they make significant interest on that. But again, understand buying on margin is basically a short-term loan that you are borrowing the money and it has to be paid back. So if you buy a particular stock at 34 and it drops down to 24, you are paying it back at what you bought it, which is the $34 mark.
Yeah, Dean, really, really good point there. Again, when it comes to the last investing move you should never make in a down market is obviously to borrow money to invest at a low point. That was something that was, there were unfortunately some financial advisors back in the early 2000s and in 2005, 6, 7 that were recommending people do that and unfortunately I've seen that happen again more recently here during the market downturn. And that's something that you never want to do. The only time you should be going and investing your money, buying in at a low point, is if you have your debt situation under control and you have a fully funded emergency fund, which is the other thing. You never want to take money that you have set aside in an emergency fund or cash that you might need for a short-term purchase and invest it at a low point to try and make more if you need the money over the short term. That's something where the only time you should be investing at a low is if you have your fully funded emergency fund and your debt situation is in check. Definitely don't want to borrow money to invest at a low point. The only time that you should be investing at a low point is if you have that cash available. We never want to borrow it.
Okay, good points, Tyler. That's all the time we have this week. See you later and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them on Packerland Drive in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.